Predicting the future price of gold is impossible, but certain economic indicators can act as red flags, suggesting a potential increase in gold prices and a potentially opportune time to consider adding it to your portfolio. As we begin 2026, let's examine 3 key red flags that smart investors are watching. Let's identify these warning signs and understand how they might impact gold. Red flag number 1, rising inflation expectations, or persistent high inflation. The signal: when inflation expectations begin to rise, or when actual inflation remains stubbornly high despite central bank efforts, it's a potential red flag for gold. This indicates that investors are losing confidence in the ability of central banks to control inflation, and they may turn to gold as a hedge. Why it matters. Gold has historically served as a store of value and a hedge against inflation. When the purchasing power of fiat currencies erodes due to inflation, the price of gold tends to rise. How to monitor. Consumer Price Index, CPI, and Producer Price Index, PPI. Track these key inflation measures to gauge the pace of price increases. Pay attention to surveys of consumers and economists, which provide insights into their expectations for future inflation. Bond market indicators. Watch the yield on Treasury inflation-protected securities, TIPS, and the break-even inflation rate, the difference between nominal Treasury yields and TIPS yields. Red flag number 2, increasing geopolitical instability and uncertainty. The signal: an escalation of geopolitical tensions such as armed conflicts, trade wars, or political instability in major economies is another red flag for gold. Why it matters. Gold is often seen as a safe haven asset during times of uncertainty. How to monitor. News headlines. Stay informed about geopolitical events around the world. Track defense spending by major countries, as this can be an indicator of rising geopolitical tensions. Country risk ratings. Monitor country risk ratings, which assess the political and economic stability of different countries. Red flag number 3, a weakening US dollar, especially unexpectedly. The signal: a significant and unexpected weakening of the US dollar can be a red flag for gold. This suggests that investors are losing confidence in the US economy or the Federal Reserve's monetary policy. Why it matters. Gold is priced in US dollars, so a weaker dollar makes gold cheaper for foreign investors, boosting demand. Track the performance of the dollar index, DXY, which measures the dollar's strength against a basket of other major currencies. U.S. trade balance. Monitor the U.S. trade balance, as a large trade deficit can put downward pressure on the dollar. Foreign exchange reserves. Pay attention to changes in foreign exchange reserves held by central banks, as a decline in dollar holdings can indicate a loss of confidence in the currency. No guarantees. These red flags are not guarantees of a gold price increase. Gold prices are influenced by a complex interplay of factors, and these indicators should be used in conjunction with other analysis. Diversification. Gold should be part of a well-diversified portfolio. Risk tolerance. Choose a gold allocation that aligns with your risk tolerance and investment goals. Long-term perspective. Gold is often viewed as a long-term investment. Consult with a qualified financial advisor before making any investment decisions. What to do when you see a red flag. Do your research. Don't blindly buy gold based solely on a red flag. Conduct thorough research and analysis to determine whether gold is a suitable investment for your portfolio. Consider a gradual approach. Instead of making a large purchase all at once, consider a gradual approach to building your gold position. Rebalance your portfolio. If you decide to increase your gold allocation, rebalance your portfolio to maintain your target asset allocation. Want to deepen your understanding of economic indicators and how they can impact the gold market? Subscribe to our YouTube channel for daily video analysis of key economic trends and their potential impact on gold prices. We provide practical insights to help you navigate the gold market with confidence. Disclaimer: this analysis is for informational purposes only and does not constitute financial advice. Remember to consult with a financial professional before making any investment decisions.